Tesla is among the top 10 most valuable companies in the world. It sells electric vehicles, is expanding globally, and has built one of the strongest brands in the industry. But Tesla is not valued like a typical car company. It is worth over $1 trillion, at a level comparable to several major automakers combined, including Toyota, Mercedes-Benz, Volkswagen, General Motors, Ford Motor, and BMW Group, while producing only a fraction of the vehicles. Its valuation reflects something much bigger: technology, autonomy, and long-term growth. And that is where the problem begins. Because Tesla's valuation depends heavily on what it is expected to become, not just what it is today. At its core, Tesla is still an automotive business. It manufactures and sells electric vehicles, builds factories, and manages production and supply chains. But the way the market values Tesla is very different. It is often viewed as a technology company, with potential in areas like autonomous driving, AI, and mobility services. This creates a significant gap. The current business is automotive, while the valuation reflects something much broader. And that gap introduces risk. Tesla's valuation is supported by a set of aggressive assumptions about the future. If those assumptions hold, the valuation can be justified. If they do not, the downside can be significant. One key assumption is autonomy. A large part of Tesla's long-term narrative is tied to full self-driving and the idea of a robotaxi network, transforming the company into a high-margin, software-driven platform. But achieving true autonomy is extremely difficult. It requires solving complex technical challenges, ensuring safety across unpredictable real-world conditions, and receiving regulatory approval. If autonomy takes longer than expected or does not fully materialize, the impact goes beyond a single product. It directly affects how Tesla is valued. Without autonomy, Tesla looks much closer to a traditional automaker, where margins are lower and growth is more constrained. Another assumption is sustained differentiation in electric vehicles. Tesla was an early leader in EVs, but competition is increasing rapidly. Established automakers are investing heavily, improving their products, and expanding their own electric offerings. Companies like BYD have already scaled significantly, even surpassing Tesla in total electrified vehicle sales, and in some periods, in pure electric vehicle deliveries. As the market evolves, electric vehicles may become more standardized. If that happens, pricing power declines. And when pricing power declines, margins follow. For Tesla, this matters more than for most companies, because its valuation assumes strong margins and continued leadership. A third factor is profitability. Tesla has already reduced prices in several markets to support demand, while continuing to invest in new factories, models, and technologies. If pricing pressure continues while costs remain elevated, margins could compress further. Lower margins reduce earnings, and lower earnings challenge the assumptions supporting the valuation. Another important issue is the starting point of the valuation. Tesla is already priced at a very high level relative to its current earnings. That means a large part of its future success may already be reflected in the stock price. Even if Tesla delivers on many of its long-term expectations, such as growth, improved margins, or progress in autonomy, the upside for investors may still be limited. Because the market is not waiting for results. It is already pricing them in. This creates a different type of risk. Not the risk of business failure, but the risk of overpaying for success. If expectations are fully realized, returns may be modest. But if expectations fall short, the downside can be significant. This creates an asymmetric situation. Limited upside, but meaningful downside. Tesla's valuation already reflects aggressive expectations. The question is not just whether it succeeds, but whether it succeeds enough to justify its price.